Good morning, ladies and gentlemen. My name is Peter Warne and I am Chairman of Argo Investments Limited. On behalf of the Board of Directors, I'm pleased to welcome you to the 79th Annual General Meeting of the company. My first as Chairman, and report on its operations and financial results for the year ended 30 June 2025. It's pleasing to be able to meet in Adelaide once again, and I see many of our shareholders and a number of visitors are here this morning. Before we begin the formalities, I'd like to inform you that the meeting is being filmed and streamed live on the company's website for shareholders who are unable to attend in person. A recording of the meeting will also be available via our website later in the day. Can I request that your mobile phones are turned to silent, please? I've been informed by the Company Secretary that the meeting has been convened in accordance with the Corporations Act and the company's constitution. A quorum is present and therefore I declare the meeting open. A disclaimer is displayed before you, and it's important to understand that the information presented today is general information only and is not a securities recommendation or statement of opinion intended to influence any person in making an investment decision. You should consider seeking independent professional advice before making any investment decision. I'm now pleased to ask my fellow directors, our Managing Director and Company Secretary, to introduce themselves. First, Leanne Buck.
Good morning, ladies and gentlemen. My name's Leanne Buck. I joined the board in 2022 and I chair Argo's Audit and Risk Committee.
Good morning, my name's Chris Cuff. I was appointed to the board in 2016 and I'm a member of the Audit and Risk Committee, and I'll be retiring from the board today after serving 3 terms of 3 years each in line with the company's normal tenure practice.
Good morning, ladies and gentlemen. My name is Melissa Holzberger. I joined the board in 2023 and I'm currently a member of the Remuneration Committee.
Good morning, my name is Liz Lewin. I was appointed to the board in 2018 and I'm chair of the Remuneration Committee. Thank you.
Good morning, everyone. My name is Simon Parrish. I was appointed to the board just a few weeks ago, actually, and you'll hear a bit more from me later because I'm standing for election today.
Good morning, ladies and gentlemen. My name's Jason Better, the Managing Director of Argo. Thank you for coming to the meeting this morning, and I'll be speaking to you a bit later.
My name's Tim Banks. I'm the Company Secretary. I joined Argo back in 2007, became Company Secretary 2010 and then Chief Operating Officer in 2015.
Thank you. I will now move on to the meeting procedures. All resolutions at this AGM will be decided by poll. As Chairman, I have called that poll. When registering your attendance today, you will have received either a green, pink or white admittance card. Shareholders or proxy holders representing shareholders were issued with green admission cards and are entitled to vote on the poll and ask questions at the meeting. On the reverse side of your green admission card is your voting paper and instructions. Only those shareholders with green cards have received a voting paper. This can be marked at any time we consider each resolution or at other stages during the meeting. After the meeting, you can place your completed voting cards in one of the ballot boxes located at the exit doors. The results of the poll will be released by announcement to the ASX later today. The holders of the pink cards are non-voting shareholders, such as joint shareholders when the other joint shareholder holds the green voting card. These card holders do not vote by poll but are entitled to ask questions at the meeting. All visitors were issued with white cards and are not entitled to vote or ask questions at the meeting, but you're all very welcome to be here today. I now open the poll. I can report that the minutes of last year's annual general meeting were confirmed as a correct record at the subsequent meeting of directors. The notice of meeting has been circulated to shareholders and I propose to take that as read. We now move to the first items of business. The audited financial statements of the company and the reports of the directors and the auditor for the year ended 30 June 2025 have been published and are made available to shareholders. In the course of receiving and considering the financial reports, I will now make some general comments about the year under review. This will be followed by an address from our Managing Director, Jason Beddow. During a period of ongoing share market volatility, challenging and uncertain macroeconomic conditions, and significant geopolitical announcements and actual events, Argo's profit for the financial year ended 30 June 2025 increased to $259.8 million. Investment revenue from companies in our portfolio also rose, up 5.1% to $285.8 million, bolstered by better-than-expected dividends from numerous holdings and several higher special dividends received during the year. In August, the board was pleased to declare a fully franked final dividend of 20 cents per share, an increase of 2 cents or 11.1% on last year. Together with the increased interim dividend of 17 cents per share, the total fully franked dividends for the year were a record high of 37 cents per share. Despite increasing the level of fully franked dividends paid to shareholders over recent years, the balance of Argo's accumulated franking credits has continued to increase. Recognising that imputation credits are more valuable in our shareholders' hands than on our balance sheet, and given the continued growth in Argo's franking account, the board considers it appropriate to meaningfully increase the final dividend. Argo remains committed to sustainably growing fully franked dividends and, for the foreseeable future, accelerating the distribution of those accumulated franking credits. The final dividend also included a listed investment company capital gain component of 7 cents per share, due to capital gains being crystallised, including those resulting from takeovers. When Argo realises a discounted capital gain, the associated tax benefit can be passed on to our shareholders as though these shareholders had made the gain themselves. This enables most individuals and self-managed superannuation fund shareholders to claim a tax deduction in relation to this gain, in addition to the benefit of franking credits. Importantly, Argo is one of the few companies able to offer this benefit due to our status as a genuine long-term investor rather than a short-term trader. This is an important benefit of Argo and differentiates us from managed investment funds, exchange-traded funds, and many other LICs. Shareholders can find more details on their dividend statement or by visiting the dividends section of the Shareholder Centre on our website. Over the 12 months to 30 September 2025, Argo's investment performance as measured by net tangible assets return after all costs and adjusted for the corporate tax we pay was 10.3%. This compares to the S&P ASX 200 accumulation index, which gained 10.6%, although the index makes no allowance for any operating costs. Over the past 5 financial years since the onset of the COVID-19 crisis, a period marked by significant global disruption and volatility, Argo has delivered a compound annual return of 12.1%, outperforming the index, which returned 11.8% per annum. We believe Argo's ability to navigate these tumultuous times and generate consistent competitive income and returns reflects the strength of our diversified portfolio and disciplined long-term investment approach, which focuses on businesses that are able to maintain and grow their dividends. As shareholders will be aware, Argo's share price has been trading at a discount to its NTA for some time. This is consistent with an industry-wide trend, with most listed investment companies offering exposure to Australian equities, also trading below their underlying asset values. We have taken proactive steps to help reduce this discount, including selective use of on-market share buybacks and purchasing shares for the Dividend Reinvestment Plan, the DRP, and the Dividend Substitution Share Plan, the DSSP, on market rather than issuing new shares at a discount to NTA. However, we believe the current discount is primarily cyclical and reflects the greater relative appeal of cash investments currently. During the COVID period, ultra-low interest rates made cash returns negligible, driving demand for LICs like Argo. Our share price climbed and traded at a premium to NTA, peaking at a 10.9% level as the Reserve Bank of Australia began raising interest rates in 2022. Cash yields became competitive again, and this put downward pressure on Argo's share price as many investors, particularly retirees, shifted capital to term deposits and other cash or income products. Looking ahead, as the monetary easing cycle progresses and returns on cash decline, we expect renewed investor demand for Argo's reliable, fully franked income stream. This should help narrow the discount, particularly as the dividend yield of the broader market continues to trend lower, while Argo remains focused on sustainably growing its fully franked dividend. Furthermore, as retail investors lose access to bank hybrid securities over time, we suspect that those income-seeking investors will also be attracted to invest in Argo shares. Over the long term, Argo shares have generally traded close to the NTA value. Over the past 10 years, the average discount has been just 0.7%, and over the last 30 years, only 0.4%. Given this mean reversion over time, many long-term shareholders see these periods of discount as attractive opportunities to accumulate shares below the value of Argo's underlying portfolio. Argo's succession plan for the Board of Directors is designed to provide orderly renewal while ensuring an appropriate mix of skills, experience and diversity is maintained. As announced at last year's AGM, the Chairman, Mr Russell Higgins AO, announced his decision to retire effective 31 December, after 13 years as a non-executive director, including 7 as chairman. The board would like to record its thanks and appreciation to Russell for his long period of service and commitment to the company and the leadership he provided. Mr Chris Cuff AO retires from the company at the conclusion of today's meeting after serving on the board for 9 years, including as a member of the Audit and Risk Committee. Chris has made a significant contribution to Argo over this time with his deep industry insight, funds management experience and diligence. On behalf of the board, I would like to thank Chris for his outstanding service to Argo. Mr Simon Parish was appointed as I think that's appropriate. Mr Simon Parish was announced as an independent non-executive director with effect from 3 October 2025 and stands for election before you today with the unanimous support of the board. Simon brings an extensive experience in the funds management industry, having worked with Russell Investment Management for over 30 years across a variety of leadership and investment roles in varying market conditions. I'm pleased to formally introduce Simon to shareholders today, and you will hear from himself later in the meeting. Australian and global markets continue to be shaped largely by geopolitical and macroeconomic forces, most notably the policy and posturing of the United States under President Trump. Aside from a period of volatility around US tariff announcements and related uncertainty, investors have largely remained willing to look through the range of risks as facing the market. Much of the prevailing optimism has been driven by the remarkable levels of investment in artificial intelligence or AI-powered technologies and wide-ranging potential applications. Looking ahead, AI technology is poised to continue shaping our lives, the economy, markets and society in profound ways, both positive and negative. Despite the market's optimism, the pace of change driven by technology development is alarming at times and not without risk. We wish to reassure shareholders that Argo's experienced board and management team regularly consider and challenge our established processes and investment philosophy to ensure that they continue to be relevant and optimised to meet rapidly changing circumstances. I remind shareholders that Argo has demonstrated resilience through many different market conditions, disruptive events and technology developments over nearly 80 years of investing. With a strong balance sheet, no debt and a diversified portfolio, Argo remains resilient to this environment. In closing, I would like to thank our Managing Director, Jason Beddow, and the entire Argo team for their hard work and dedication throughout the year. I also thank my fellow directors for their valuable contributions, and in particular, Chris Cuff for his commitment and service to Argo over many years. Finally, on behalf of the board, I sincerely thank our loyal shareholders for their ongoing support and extend a warm welcome to our new shareholders who have joined Argo in this last year. I now call upon Jason Beddow to present his Managing Director's address. Thank you, Jason.
Morning again. It's been a really interesting year for markets, and I guess, in some ways it's amazing how quickly 2025 has gone. The noise of the markets, what's happening with geopolitics. It's equally hard to believe that it's only been a little over 9 months since Donald Trump's inauguration, which sometimes feels like a lifetime ago. So it's a really interesting time. For most of last year, if I just go back a little, markets globally were fixated on when the US Federal Reserve would begin its monetary easing cycle. The first interest rate cut was in September 2024, and this pushed markets to highs at the time. However, following the election of Donald Trump, President Trump, expectations of accelerating inflation from tariffs put further rate cuts on hold, and the US Fed didn't cut rates again until last month, September 2025. But this, combined with the global frenzy in AI investment, has pushed US markets to all-time highs. Not alone, gold, Bitcoin and many other asset classes have followed this upward trajectory. The US now dominates global markets more than ever. It used to be circa 50% of global markets, it's now north of 70%. And the US is really at the epicentre of current AI and the tech investment boom. And the numbers themselves are quite frightening. But the top 8 companies in the US are now worth $22 trillion US. To put this in context, Nvidia alone at $4.5 trillion is about the same size as the German economy, which is the 3rd largest globally. The growth of many of these companies has been fueled by this rush of AI-related investment. According to JP Morgan, approximately 46% of the S&P 500, its market capitalisation, is now somehow linked to AI. Now, this has pushed the overall market valuations on a simple price-to-earnings ratio to levels not seen since the first tech boom back in the late 1990s. Now, where do we go from here? I mean, if history is any guide, the current technology rally may have further to run. So it's worth remembering, despite markets looking expensive back in the day, they doubled again between October 1999 and March 2000. And while we're certainly not suggesting that markets will follow that same trajectory, those who've followed markets long enough, will recall how that all ended. So following this strong lead in the US, and this is for most markets around the world, Australian equities are also very strong. Similarly, trading around all-time highs. Yesterday was another all-time high in the Australian market, and we're up about 7% since June 30. Certain parts of the market have had amazing share price performance since that short-lived sell-off in April, which almost feels like April last year, following Donald Trump's Liberation Day tariff announcements. For example, stocks like Life360 up 300%. Gold stocks have nearly all doubled. So there's some pretty big moves in the Australian market in the last 6 months. In fact, even the broader market, the general market, has been a really strong performer. It's been a stellar period for equity investors, with the S&P ASX 200 index up around 50% in the last 3 years. Now, while we clearly want and do have some exposure, to these high growth and high quality, high multiple stocks, we do continue to diversify our portfolio, to maintain that balanced long-term performance and also to deliver shareholders that relatively smooth and growing dividend profile through different market cycles. So with this in mind, our recent acquisitions have primarily focused on companies offering strong cash flows, complemented with a smaller selection of higher growth businesses in the early stages of their development. So we continue to believe, one of the, trends is that commodity demand will continue to remain strong, driven by increased spending on defence now, adding into the data centre build-out, and more importantly than the data centres is the electricity demand and transmission required to power them. Continuing rollout of renewable energy assets. This is driving a lot of commodity demand globally, taking a little bit of pressure off, the demand that China has provided for the past 20 years. Also, the supply side is going to take longer and cost more to deliver than expected, and this should support higher commodity prices over the long term. So regardless of any shorter-term impacts of increasing trade tensions between China and the US, and that can happen any day of the week, we do think the longer-term trend for the existing producers is solid. So in line with that thematic, we've modestly added to our BHP and Rio Tinto holdings and also Worley. We've added to Amcor, Clarity Pharmaceuticals, which is a stock we've owned for a while now, Sonic Healthcare and CSL. And I'll come back to talk about CSL as it's a well-held stock in the market. Generation Development Group is a new holding for us, and that's benefiting from very strong structural tailwinds in the superannuation industry. And we've also made a modest pre-IPO investment in Firmus Technologies, which is a data centre company with intellectual property assets in liquid cooling. On the sales side, we've fully exited positions in GPT, Crisis Corporation and Helios. Helios was a disappointing investment after showing so much promise during COVID when it generated a lot of cash and got itself into a very good balance sheet position. With rich share price valuations, we've also recently trimmed our holdings in Eagers Automotive, which has just done what we think is a really good deal with a Canadian auto distributor, but equally the share price has doubled, and Lynas Rare Earths, and they're both up over 100% in the past 12 months. And we've also modestly trimmed our holdings in Macquarie and Wesfarmers. These are very small sales relative to the size of our holdings, and we still like these companies. CSL, though, has probably been one of the most hotly debated stocks, I think, in the Aussie market for the last couple of years. And it serves as a great example of how market sentiment and also emotion can influence share prices just as much, if not more, than earnings and growth forecasts. So I mentioned Helios. Globally, the healthcare sector was perhaps the most negatively impacted by COVID. In CSL's case, these effects were compounded by management changes, a couple of own goals, to be fair, and some failed R&D projects. And this led to a period of flat and disappointing earnings for perhaps the first time in CSL's history. Now, CSL's earnings per share is in the orange columns there, and I guess it had a relatively flat period for CSL. Adding to this, globally, proposed reforms to the US Affordable Care Act, advocated by US Health Secretary Robert F. Kennedy Jr., are raising concerns about future health policy and how much these companies will be able to charge patients, in time. So healthcare company share prices globally have fallen, and this has added additional uncertainty. So what does this mean for CSL? So earnings per share have fallen slightly, but the forward-looking expectations, which are the bars on the right-hand side of the graph, and this is from the market, so we take them with a little grain of salt, but the expectations are positive, are still pretty robust. Historically, through time, CSL's traded at a pretty meaningful premium to the broader market, and that reflected its earnings quality, the consistent growth, and that is the red line above the blue line, so quite a premium. However, the market is now significantly discounting or not believing the earnings to the extent that for the first time really ever, CSL's forward price to earnings, or the multiple, the PE multiple, is below the market average. So the market is, I guess, wanting to pay less for CSL's earnings than other companies in the market. So I guess we think that is an opportunity. We think 2026 is still going to be a pretty complex and messy year for CSL. They've announced plans to demerge a division, Seqirus, with their influenza business. It's very cyclical. They've stepped away from their pre-COVID plasma guidance, the margins. And in addition, just last week, Chief Financial Officer Joy Linton resigned. So they have a lot going on. But despite these challenges, we do believe that the share price reaction is overdone, and we do expect CSL to regain investors' confidence and attention over time. So I guess lower earnings and higher stock prices have pushed the Australian market to record high PE ratios as well, and similarly, record low yields. Now, the market does look expensive versus history, and we're not disputing that it is, but we do think there's a couple of relevant points, supporting higher valuations in the market. We do think the quality of the Australian market has never been better, as in there are more growth-focused and capital-light companies that are less capital-intensive and much less cyclical. There's also a record number of stock buybacks currently supporting valuations, and just in the recent reporting season we had in August, an additional 17 companies announced new or extended buybacks, and that's another $8 billion of stock these companies will buy back on market, also supporting share prices. And mandated superannuation flows are at record levels. We've got strong employment, we've got population growth, and we've got increasing contributions, which went to 12% in July. And this is all continuing to help bolster the market. I guess as a result, though, the cash dividend yield for the S&P ASX 200 is now 3.2%, and that's as low as I guess we've seen. So this compares to the cash rate at 3.6%, 10-year government bond is around 4.1%. So even including franking, which is only partial in an index perspective, Australia's equity market no longer provides quite the same yield it once did. So in this context, we believe Argo's investment appeal increases, particularly when compared to an Australian index tracking ETF or cash. So although both Argo and index ETFs offer extremely low cost exposure to the Australian market, their differences after that are quite stark. Notably, while the index dividend and franking levels have declined, we continue to grow our fully franked dividend. And based on the current share price and the 37 cents per share fully franked we paid in the last financial year, our cash yield is 4%, and when franking credits are attributed, 5.7%. So quite a meaningful difference to cash. Our portfolio turnover is low. Now we believe that's prudent in minimising tax leakage for shareholders. We have quite a lot of unrealised tax. That unrealised tax we have as investments is earning dividends. Otherwise, we do sell and we do turn over the portfolio, but we think excessive tax leakage to the ATO is not in shareholders' best interest. So rather than sort of pursuing a high turnover strategy to chase short-term index returns, we're a little bit more prudent. However, we would argue the positioning of the portfolio is quite active. 7 of our top 20 holdings are not in the index top 20, and 16 of the 80 holdings are not in the benchmark index at all. Stocks that we think have a great growth potential or are something different, even though they're not in the index. And we believe this portfolio positioning will deliver superior dividend growth and, in time, capital appreciation compared to the index. Although, we do acknowledge that achieving both at the same time is a challenge, and, we do manage the dividend growth and the capital appreciation. But with our current portfolio and franking balance, we're confident we can conservatively grow and sustain Argo's fully franked dividend. We believe this will become increasingly attractive in a lower yield world, especially against partially or unfranked alternatives. And we continue to believe that the fully franked income growth alone is a compelling reason to own Argo. So we think about, we're just about into AGM season. We'll have the banks reporting this week, which is a great bellwether for the economy. Corporate Australia is in pretty good health. We had a reporting season throughout August, and generally speaking, companies are managing the environment well on costs. Revenue and balance sheets are very, very strong. So these companies have been relatively well managed through a period of heightened uncertainty. There is some support from the previous interest rate cuts in the economy, and they will continue to filter through. And there's potential for a further cut on Melbourne Cup Day, November 4. Consumer-facing businesses should face improving conditions as lower interest rates begin to ease the cost of living pressures. And prices of fuel, shipping and imported goods have also fallen. The macroeconomic data reflects a pretty resilient economy. However, we think the biggest challenges and the outlook remains highly contingent on what happens offshore, to be fair. And we remain alert to the challenges, including the geopolitical uncertainties. As we've seen in the past fortnight, renewed tariff tensions between the US and China particularly, once again spooked the markets. I mean, even if it was only for one day. But that sort of happened just as it appeared that the major tariff-induced volatility was behind us. So given that there are still, we think, a lot of global risks persisting out there and the valuations remain stretched, we continue to take a pretty conservative approach to managing the portfolio. And in this environment, I continue to sort of highlight the defensive and diversified nature of Argo's portfolio, which are attributes that help ensure our portfolio is less susceptible to sharp market swings, if and when we do get one. I'd also like to acknowledge and thank all of the Argo staff. It's a pretty small team, all fully committed to the company's success and for shareholders and across the two offices. All of the Adelaide office you've probably seen this morning. Also like to acknowledge and welcome Peter Warne as the new chairman of Argo. I've enjoyed working with him this year, and I also acknowledge all of the non-executive directors, and I look forward to working with them as we best navigate Argo through the next period for you, the shareholders. I'd also like to particularly thank Chris Cuff for his contribution to Argo as a board member. It's been a great pleasure for me personally, debating markets and stocks with him, and I'll miss your inputs and market feels, so thanks, Chris. And I do wish you well in all your future endeavours. And on that note, I'd also like to congratulate and welcome Simon Parish to the board, and I look forward to continuing the strong relationship that I and the whole executive team and staff have with the Argo board. I'd like to wish you all well, even though it feels like there's a bit of the year to go. Once we hit Melbourne Cup, that's it. It's a bit of a slide straight through to Christmas. So I'd like to wish you all well for the remainder of the year. We thank you for your continued support, for coming along today. Equally, coming to the roadshow, that's becoming a bit more of an event, which we do in May, and I look forward to seeing you there next year. So thanks very much.
Thank you, Jason. Ms. Bianca Denario, my apologies, Bianca, audit partner from the company's external auditor, PricewaterhouseCoopers, is present today and available to answer any questions relevant to the conduct of the audit and the preparation and content of the auditor's report for the year ended 30th of June 2025. Shortly, I'll address any shareholder questions on the financial reports and any general matters, bearing in mind that we will separately consider the remuneration report and other items of AGM business later in the meeting, at which time there will be opportunities to ask questions relating to those items. To ask a question, please ensure that you have your green or pink card and make your way to the microphone located in the front. We have one right at the front here, another one in the middle of the room, so that all shareholders can hear you. Please state your name and any affiliations when invited to speak, and limit yourself to one question only in consideration of other shareholders. Are there any general questions or comments about the company or its financial report at this time?
Thank you, Mr. Chairman, and good morning. My name is Greg O'Connell, and I represent 3.4 million open proxy votes and 213 shareholders on behalf of the Australian Shareholders Association. Thank you for the presentations to date. I found them very informative. First, I would like to acknowledge the time spent by Argo, including the chairman, in speaking with ASA at a pre-AGM meeting earlier this month. We found the meeting informative, the discussion transparent and helpful in understanding Argo's operation and performance objectives, so thank you. Second, I'd like to acknowledge an item that we observed in Argo's FY25 annual report, and that was the inclusion of the one-page summary letter, cover letter from the Chair of REM describing this year's REM calculations in an overview summary form. We found this very shareholder friendly and helpful before diving into the details of the REM report, so thank you for that. And lastly, both in the annual report and in today's presentations, and I appreciate both of those, is the clarification of Argo's focus on delivering above market levels of reliable, fully franked dividend income and also capital growth. Very helpful in helping us assess our views on the remuneration report. I have some questions I may ask later on, but Jason caught my interest. I have a off-the-cuff question, if I can ask it. Sorry, no puns intended. About buybacks, Jason, you emphasised the high PEs and the high valuations in the marketplace, yet at the same time there seems to be a record level of companies making buybacks, which to my mind is a bit counterintuitive. Perhaps you could comment on that, please.
Yeah, sure, Greg. Look, I think it varies for different companies. I think we've got a lot of the companies buying back stock have big international businesses, so that they don't have enough franking to pay bigger dividends. Brambles would be an example, Worley and others. So they are with the rule changes from the ATO on the off-market buyback structure, which has also gone. That has also restricted some of the ways that companies that do have additional franking can get returns back to shareholders. So look, these companies that have got very strong balance sheets, they don't want to become net cash. It's, I guess mechanically and for their returns is not great. So they're buying back stock. So yes, we would argue, valuations are pretty stretched, but I guess these companies are doing well, generating a lot of cash, and they've got to do something with the money. So short of, we'd probably rather them buy back their own stock expensively than go and do random and rash M&A and overpay for businesses that are probably not great. So I think it's just a state of, as I said, the balance sheets are pretty strong. Companies are generating pretty good returns, but particularly those that generate a lot of income from offshore, that don't have the franking. Paying unfranked dividends is certainly not as tax effective as shareholders or the company.
Thank you. And just as a last point, I'll highlight that ASA expects to vote for both of the motions being put to the meeting later on. Thank you.
Thank you, Greg. I have a question from the middle of the room, please.
Hi, my name's Peter Croft. I'm one of many shareholders of Argo who are concerned about climate change. And we've seen this in extreme weather events in eastern Australia and southwest Queensland this year. And in South Australia, we're currently experiencing a harmful algal bloom which has profoundly affected our beaches, our fishing, our aquaculture and tourism. And the government has advised that, and I quote, warmer ocean temperatures made more likely by climate change have created the perfect environment for the bloom. So we're concerned. But at the same time, Argo shareholders also look for a reasonable return. So my main question is, in Argo's view, what practical options exist for small to medium-sized investors who want to do something about climate change but still need a reasonable return? Is Argo the company for us? I have a supplementary question. What progress has Argo made in implementing the Australian Sustainability Reporting Standards?
To answer your first question, perhaps I can pass that one to Jason.
Yeah, sure, Peter. Thanks for your question, and we spoke earlier. Look, I think it's very personal, as you say. It is difficult for small and medium shareholders to be heard, and I guess that's why groups like the ASA exist. And there are, I guess, funds available for investors that are ethical or very green. The challenge that they have had in recent time is they do have poor returns because a lot of the direct investments they can make are not great. Look, we think Argo is a good vehicle for small and medium-sized shareholders, but we do not have as you would say, I guess, we are not an ethical mandate. We are certainly not a green mandate, and we have to use what's available in the Australian market to get returns for shareholders, and that's a combination of the capital growth and the dividend growth. We are very aware of ESG policies, and we have learnt a lot in the last 12 months, and not to steal the Chairman's thunder answering your second question, we have an internal team spending a lot of time and money working on how we will report, but for Argo, our biggest, I guess the biggest part of us will be what is our investments. I mean, we do not generate a lot of carbon with 15 people in 2 small offices and half of us ride push bikes to work. So it's really the scope 3 of what we're investing in, and that's been a really interesting process, and talking to other companies about how they are going to be reporting on that, which comes in this current financial year. So we'll all have a lot more information available to us over the course of the next 12 months. But we know anecdotally, we know who the big polluters are in the economy, but equally, if that's their business, it's very hard to say we won't invest in BHP because they have a carbon footprint. I mean, they're a mining company. By definition, they are going to be at the dirtier end of the market. So it's a real juggle. So we think we do it ethically, we think we do it very deliberate, we vote ourselves, we have good interaction with companies, boards and management teams that we invest in, but we are not, I guess, hanging a shingle up to say that we are a green or ethical fund, because at the moment there's just not enough investment choice, we think, or to get the returns. So I'm not sure that sort of really answered your question, but that's where we're at. But there's a lot of work going on. And Steve, who's sitting in the front row, put your hand up, Steve. Steve will be having to report. The environmental reporting is going to be audited. It will come under the audit partners. It's a lot of work, and he's, I guess, chairing an internal committee, doing a lot of work with an external party, and you should definitely speak to him afterwards.
I will.
Just to follow up on that, yes, our obligations for the climate reporting standards commence this financial year, so as of 30 June 2026 we'll need to commence our reporting, and as Jason just said, we have been actively working on that at least for probably the last 6 to 12 months of starting that process, and working out exactly what reporting we need to do and where we will be getting the information to complete that reporting, and we certainly engaged external consultants to assist us with defining exactly what we need to do and how to go about that, and talking to our auditors about what we need to have in place so that they can provide assurance in relation to whatever reporting we end up completing. So that process is well underway. I think just to follow up on your first question in relation to which Jason has answered, certainly the climate risk element is something that our analysts take into consideration when they're making their recommendations about whether we should invest in a particular company or not. A strong analysis of how that company is and its business is exposed to climate risk and exposed to climate regulation. So that is an element that goes well and truly into our investment choices.
Okay, thank you for your answers, and as Jason knows, I will be back at a future AGM.
And we're always delighted to see you. Another question from the middle of the room.
My name is Ross Hill-Brown. I'm a very humble small shareholder. following up from the question on climate, can I just clarify, next year, will there be a supplement in the annual report on where you're going with climate?
In terms of our climate reporting?
Yes.
Yes, well, that's our obligation under the changes to the accounting rules, that we need to publish detailed information about our emissions reporting, our emissions not only consumed as a company, and as Jason said, that's very small given our very small nature, but also following on to the impact of our the emissions of all the companies in which we invest. So we need to accumulate that data and report on that data.
And it'll be easy to, it'll be summarised in an executive summary?
It will be summarised. It'll probably be there in some detail. Whether it will be easy, that is another challenge because we're yet to get there.
I understand that.
But we'll be making it as easy and straightforward and readable as possible. There's no doubt about that. Meeting at the...
G'day, Peter. My name is Tony Greco. I'm also a member of the Australian Shareholders Association, but I'm asking this question as a personal shareholder. And it's a question I've also asked Australian Foundation Investment at one of their meetings. So I take your point that you want to focus on dividends, but I'm just trying to understand why BHP deserves ongoing investment. I just saw their name come up again. Argo's been topping up its investment in BHP each year from 2021 to 2025. In that period, Argo's purchased about just over 3 million shares, and using the average price at 30 of June each year, I make that about $131 million worth. Could be a bit less if you bought on dips. But the dividend income from that holding, from the BHP holding in total, has decreased from just under 23 million US in 2021 to 11.5 million US in 2025. And in the letter from the from the chairman on the 2023 and 2024 annual reports, mention was made that, oh yes, we also had less dividends from BHP. So could you please explain why, with the research, Argo and Stu, I'm sure they do a great job of research, and the investment process on page 7 of the annual report, there has still been significant investment in BHP over the past 5 years, and we're getting lower and lower dividends. It may turn around eventually, I guess.
Sure. Yeah, look, I guess that's sort of largely factual. I mean, we probably back in 2021 realised the dividend profile of BHP was going to do that. So we've budgeted for that dividend all to be cut because they were largely paying out dividends from asset sales. And so it was massively inflated when people were buying BHP for dividend back in 2021, 22. Very unsustainable for a mining company. So we factored that all into our process. And when we're looking at dividends, we're looking at the portfolio, what the portfolio will deliver. Otherwise, we'd never invest in a stock that didn't pay a dividend. And, they're some of the highest growth and best quality stocks in the market. So, we spent a lot of work, the team spent a lot of work, and, I mean, to be fair, the dividends are not well forecast by the market. So anyone that was buying BHP for sustainable dividends back then was, not doing their own research or being told something that was unsustainable. So that's that side of it. We're quite comfortable with the dividend cuts to where they are. At this price, we think about where the commodity cycle is and the current dividend. The current dividend's, let's say it's around 5%, so it's probably halved. CBA dividend's probably 2.5 at the moment. Wesfarmers 2.2. And as I said earlier, the whole yield of the market's fallen, particularly in the big caps as the market has, the share prices have risen. And we think the cash that BHP will generate over the next years with the copper growth, quite a lot of copper growth going to come out of South Australia and other things, that it's going to generate and have earnings growth, and we'll get back to dividend growth. And we don't see as much of that probably in some of the industrial companies.
All right, thank you. Thank you for that. Actually, just FYI, AFI, their answer was that they like the copper part of the BHP story, so that's what they were interested in. Just as a side issue then, I noticed one of the trends when comparing 24 and 25 that a few of the holdings in companies whose share prices have dropped you bought extra of those. So, your James Hardie, Novonix, Monash IVF, Steadfast Group, Viva Energy, Treasury Wines, Woodside Energy. So I'm assuming that there's been the research done to say they were good companies, they're a bit out of favour, we still are happy with them because you're buying these ones that are currently out of favour. Is that the process?
Well, I think that's what we try to do. We'd always like to buy good companies at least a fair price. If we think the longer term outlook, and so from your valuation perspective, your cash flow, your dividends are sound, as I used with the CSL example. I mean, CSL's earnings haven't really dropped much, but the market's wanting to pay almost half the multiple. So for every dollar that CSL produces now, the market was happy to pay 40 times, and now it's going to be paying maybe less than 20 in the future. So there's a lot of emotion in the market, a lot of short-term money, and so we need to think about the longer-term, I guess, structure of an industry. Like Treasury would be one you go, well, actually that probably has got a few challenges, the wine industry, just global trends in China. But a lot of them, the share price moves, we think, are well overdone. And so if we think the long-term valuation hasn't moved much, and that discount to the share price, or the share price discount, is justified, well, they're going to be more attractive than chasing stocks we think are getting very expensive.
Okay, thank you for that.
Thank you. Now, we have a number of questions that have been sent in, but we have another live question, so in the middle of the room, please.
My name's Colin Pilcher. I've got a couple of comments to make. The first one is I'm pleased that you've only got a small percentage, even though it's 25 million, in cash, because I'm an investor. I like to see you invest it. I can invest in cash. I don't need help to do that. So that's a tick for me. The other thing is that it's pleasing to note that you're sort of on the way defensive, but also looking for one eye in the future for some growth, which I think it's a good move at the moment. So that's another tick from me. And the other comment I'd like to make is about ethics. Warren Buffett, supposedly when he recruits new workers, the most important thing he looks for is ethics, because if you're not ethical, you'll ruin the company or basically put a black mark on for many years. So what I'm saying is about the environment and whatever, I know you can't get carbon neutral in a number of years. It's not practical, but you can be ethical about it and try and reduce the carbon, or have one eye on carbon reduction rather than elimination. Thank you.
Thank you very much. Just in your comment regarding to our cash reserves, we, as a matter of course, tend to be reasonably fully invested, but over the course of the year, as we receive dividends, we tend to build up a cash buffer, which we then use to pay our dividends at the end of the year. So through the course of the year, we tend to build up cash, pay the dividend, and then commence that. So as we balance at end of December or at end of June, when we publish our accounts, we're always likely to have some amount of cash there as we're preparing to pay the dividend in a few months later. Did you want to have any more comments in relation to what?
No, look, thanks for your comments. Look, the cash does move around a bit. Like, unfortunately, my CFO is taking $40 million to pay the ATO in a couple of weeks, so that 25 won't quite be enough. So look, it does fluctuate. I mean, Argo's an $8.5 billion balance sheet now, so the numbers can be quite large. But yeah, look, we generally are fully invested. To be fair, if I thought there was a crash coming and you could predict it, you probably would like a little more cash and that sort of time. But look, we are generally fully invested, and I would argue, up to 1% of cash, I would still classify as pretty fully invested.
Thanks, Jason. Yes, another question.
My name is Michael Katsu, and I have a fairly large holding in your company. I just believe that you have fewer shareholders than you did last year. Can you suggest any reason why that might be the case?
Yes. Well, I can. What we do discuss, that's a point we do discuss, and we have some theories in relation to that. What we found is during the COVID-19 epidemic, and as Jason and I explained earlier, during that period when cash rates were very low, we attracted a large number of new investors who were seeking a cash return on their savings. That obviously pushed the share price up, pushed the premium to NTA up, but also just pushed up the number of shareholders dramatically from what it had been. Since the COVID period, we've noticed that a number of those shareholders have sold their holdings and we suspect have moved back to term deposits and other cash type investments. That's reduced the number of shareholders, but also has, as we've already discussed, resulted in a discount to the NTA for the share price. So those two things I think are very linked.
Thank you.
As I was saying, we have received a number of questions which have been sent to us, and we undertake to answer those questions. The first question comes from David Bryce. David asks, I would like to inquire whether Argo has ever considered to broaden their investment world to the USA, where it seems the technology world seems to be centred, i.e. NVIDIA. Our response is including international shares in Argo's portfolio has been considered regularly over Argo's history. In fact, we have a paper written by Sir Donald Bradman when he was an Argo director, which considered but did not recommend adding international equities to the portfolio. We prefer that Argo remains true to label as an Australian equity investment. If shareholders wish to add international exposure, they can certainly do so on an individual basis or through other investment vehicles such as Argo Global Listed Infrastructure, which we floated 10 years ago to provide a diversification option for Argo shareholders. The boom in AI and the large technology stocks has certainly brought the topic into focus again. But to date, we prefer that shareholders choose for themselves whether to invest overseas rather than forcing exposure on existing Argo shareholders. The second question comes from David Southern and relates to me. I have just read the annual report and have noticed that the chairman does not own any shares in the company, but is happy to take his fees. Would love to hear your comment. The company's, and my response is that the company's non-executive director share ownership policies require non-executive directors to establish a level of share ownership in the company with a value equivalent to the annual base fee within 3 years of appointment. And I certainly intend to comply with that requirement. Next question comes from Dinaz Mistry. Although Argo's performance is good, then why is its share price trading at a significant discount for quite a while relative to NTA? And is this a trend which indefinitely continues, thereby discouraging further investment? Improvement of this should be one of the objectives of the management team. We agree that this is a real challenge and that the management team is very focused on active measures to reduce the discount. Sentiment for listed investment companies broadly continues to be challenged, reflected by historically high share price discounts to NTA across the sector. We believe, as we've already said, that this is cyclical and sentiment has been challenged by more competitive cash interest rates and the rise of ETFs. In response, Argo activated its on-market buyback in November 2024 and May 2025, buying back over 3 million company shares in total. The company also recently has been purchasing on-market the shares required for the DRP and DSSSP participants, rather than issuing new stock at a discount to NTA. These activities are accretive to earnings per share, but have not yet reduced the share price discount. We have a question from Mr. Guy Bogue. Can you please state the LIC capital gains clearly every time a dividend is announced, even if it is zero? In response, we will include this on all dividend statements from now on. For your reference, we only include LIC capital gain components on final dividends, not interims, once the company's full year tax situation is certain. They don't occur every year, and as we wait until a meaningful level of portfolio gains have been built up. This can vary depending on the direction of markets, but in recent times it has been every second or third year on average. And the final question we have we did have some questions from Peter Croft, but Peter has joined us and asked them personally, so that I don't think we need to repeat those. We also have a final question from Keith and Sharon Notley. Would the Argo board consider providing monthly dividend payments to shareholders? Several LICs have recently done this with what I believe are promising results. The main rationale, I believe, is that it would alleviate the high ex-dividend spike in the share valuations, followed by the share price plummeting post-dividend harvesting. A more even share valuation over time, as well as the benefits of more controlled cash flow with monthly dividends, would make new investors consider investing in Argo, I believe. Well, yes, the board and management have considered increasing the frequency of dividend payments, which are currently biannual, and we continue to consider the pros and cons of this option. However, at present, we're not sure that the benefits would outweigh the additional cost to the company. We have a very large shareholder register with currently 88,000 shareholders. Each dividend run requires quite a bit of work from management and considerable expense, in addition to further processing costs at the share registry. There are significant printing and postage charges with each dividend run, and as we still have many shareholders who request hard copy dividend statements to be posted to them. Monthly dividends would considerably multiply these already substantial costs. Perhaps a quarterly frequency would be a compromise, but that may not be enough to achieve the desired effects, despite doubling the annual dividend costs. However, we recognise the current appetite for regular income products and will continue to monitor its development closely and certainly examine all opportunities. Perhaps if you have a strong view on that particular point, you might mention it to the Argo staff or my colleague directors outside while we're sharing some refreshments. If there are no any other questions, we might move on to the other items of business. The Corporations Act requires all ASX-listed companies to submit a remuneration report to their shareholders for consideration and adoption by way of a non-binding resolution. Argo's remuneration report is detailed within the annual report and outlines the company's executive remuneration policy and its relationship with company performance. No changes were made to the company's remuneration framework this year. The key principles of Argo's remuneration strategy are to align the remuneration structure with shareholder interests, to link a significant component of remuneration with the creation of shareholder value through dividend growth and portfolio performance, and to ensure remuneration is competitive and fair and attracts and retains and rewards talent. Ensuring that our remuneration structure is linked to value creation for shareholders is achieved by awarding the Managing Director and specified executives with a combination of fixed remuneration, short-term incentive or STI, and long-term incentive or LTI opportunities. Alignment of the long-term interests of shareholders and executives is achieved by a significant component of executive pay being performance-based or at risk and measured over an extended period, and also by awarding some of the executive remuneration in the form of Argo shares rather than cash. All our employees are Argo shareholders. Performance is measured relative to Argo's listed investment company peer group and the ASX S&P 200 share price index. The company's remuneration structure is explained in detail in the remuneration report. Within the annual report, the board considers that it is fair, competitive, and aligns Argo's corporate objectives with the interests of shareholders, and genuine rewards sustain good performance achieved without taking undue risks. I now move the motion that the remuneration report for the year ended 30 June 2025 be adopted. Could I ask any shareholders to wish to ask a question regarding the remuneration report specifically, please make their way to the microphone. For your information, the details of the proxy votes received on this resolution now appear on the screen. Please note that this resolution is advisory only and does not bind the directors or the company. However, should 25% or more of shareholders vote against the remuneration report for 2 years in a row, then the shareholders of the second AGM will be asked to vote on whether all directors should stand for re-election. We have a question in the middle of the room, so thank you.
Just a simple question. The shares that are allocated to directors, are they bought on market or do you issue new shares?
No shares are issued to directors other than the managing director. They are, in terms of the STI shares, they are bought on market. Okay. In terms of the LTI shares, that can depend. And certainly that is the case at the moment, where we're trading at a discount. If we were trading at a premium, then it would make more sense for us to issue shares in that environment. But it's all taken into consideration as it goes through the accounts.
Thank you.
I now put the resolution to the meeting. I remind you that we are voting by poll. If applicable, please mark your green voting card for item number 2. Thank you. I now move on to the next item of business. Mr. Simon Parish was appointed to the board in October this year as an independent non-executive director following an external search process which identified that his executive experience and knowledge of the investment sector in particular provides a skill set that is ideally suited to the board. In accordance with the company's constitution and being eligible, Simon offers himself for election by shareholders today. The details of Simon's qualifications and experience are included in the notice of meeting. The other directors unanimously recommend that shareholders vote in favour of Simon's election, as they consider that he is well qualified to be a director of the company. I now invite Simon to address the meeting.
Thank you, Peter, and good morning, ladies and gentlemen. My name is Simon Parish. It's a privilege to be here today and stand for election as a non-executive director of Argo. As a new director, I'd like to give you some background on my career and experience and to show why I think I can serve your interests well on the board. So, like your managing director and portfolio manager, Jason Beddoe, I studied engineering at uni. In my case, I did civil engineering at UWA in Perth. After working for a few years with Clough Engineering, mainly in Perth, I went to business school in Sydney and was then recruited by what is now called Russell Investments. Russell is a global investment firm headquartered in Seattle in the US, and has been a pioneer in many areas, including institutional asset consulting, fund manager research, and multi-manager funds. I spent 31 years with Russell, starting off as a consultant in Sydney and Auckland, before moving to London to join the multi-manager funds business in the 1990s. I became part of the investment team, and over the period between then and when I left Russell a couple of years ago, I managed multi-manager funds across a number of different asset classes, focusing mainly on equities, and most specifically Australian equities, after returning to Sydney in the year 2000. I was the Senior Portfolio Manager for Australian equity funds from 2000 until 2023 when I left Russell. So as part of that role, I was instrumental in the process of researching fund managers and responsible for hiring and firing the managers in the funds. So this gives me great experience in the art and science of assessing investment teams and diagnosing any issues that may arise. In addition, I had directly managed components within the funds which use model-based approaches for stock selection, and through this I learned a lot about issues of portfolio construction and risk management. Since being offered the Argo role, I've had the opportunity to meet most of the investment team and to learn about how they manage your portfolio. I find the investment approach appealing and well suited to the objectives of the company. I have conviction in the process and the team, and I'm keen to add perspective from my experience and to help ensure that it continues to deliver the results over the coming years. As well as my hand-on investment role, I was also strongly engaged in the governance of Russell's funds. I was on the board of Russell Investment Management for 23 years, and as part of this role had to work through many challenging issues. That complex has AUM of over $20 billion, including dozens of funds across many asset classes, including hedge funds and private assets. Since leaving Russell in 2023, I've been devoting my time to family, friends and travel, and now I'm excited to get back into an investment-related role, and one where I have the opportunity to represent the interests of the investors in this storied company. This is my only work commitment at this time, so I have the capacity to devote as much time as it takes to do the job well. While I may seek another or maybe two other board roles, I expect Argo to remain the top professional priority for me. So if elected, I look forward to working with the board and Argo's leadership to serve you, our shareholders, and to deliver on the objective to deliver strong long-term returns through fully franked dividends and capital growth. So it would be an honour to join your board and respectively ask for your support in my election today. Thank you.
Thank you, Simon. I now move the motion that Simon John Parrish be elected as a director of the company. Can I ask that any shareholders who wish to ask a question regarding that resolution, please make their way to the microphone. For your information, the details of the proxy votes received on this resolution appear on the screen. A simple majority of greater than 50% in favour is required to pass this resolution. Are there any questions relating to Simon's election? I now put the resolution to the meeting. If applicable, please mark your green voting card for the item number 3. Now, that completes the formal business of the meeting. The poll will remain open for a short time after you leave the meeting to allow you to submit your votes as you leave. We will announce the results of the poll to the ASX later today. If there's anybody that requires assistance filling in the voting papers, please ask one of the representatives of Argo or Boardroom that are either at the back of the room or outside. Can I remind you that the 10th Annual General Meeting of Argo Global Listed Infrastructure Limited, which is also managed by Argo personnel, will be held in this room at 12:30 today. Argo shareholders and other visitors are invited to attend, but you will need to register separately for that meeting at one of the booths in the foyer outside this room. You do not need to be an Argo infrastructure shareholder to attend. During the break between meetings, the directors and senior executives and other staff of both companies will be available to take any questions you might have outside. Please don't forget to place your voting paper in one of the ballot boxes as you leave the room. I would like to thank you all for your attendance and your questions. It's been great to see you. I declare this 79th Annual General Meeting closed and look forward to seeing you at the 80th Annual General Meeting next year. I now invite you to join us for refreshments in the foyer, and thank you again for your attendance.